So as far as the psychological aspect of the business is concerned, people who are not doing well, not because they are not good at technical analysis, but because they have psychological problems as far as trading is concerned, they make certain psychological mistakes. And we are coming to look at those mistakes and break them down into detail. They make certain psychological mistakes, and I'm going to talk of them. There are 4. Okay? And I found this out through my own experience and through videos of Mark Douglas that I watched. He's one of the greatest trading psychologists of all time. I have a lot of his videos, mostly during the weekend. Me, I'm a nerd. Okay, if I am not learning new stuff and practicing and preparing flashcards that I can learn from, looking at the charts and preparing flashcards that I can learn from, I am watching videos on trading psychology. I usually do that during the weekend. The weekends are for you to relax, chill, and then get your mind right. And one of the ways you can get your mind right is to watch videos on trading psychology. Okay, for those of you who are living in towns or cities where you have the ocean, where there are oceans, weekends, just go stand by the ocean. Don't go into the water, especially if you don't know how to swim. Stand by the ocean or sit by it and just look. It's very refreshing for the mind. Very, very refreshing. Clear your mind. Just go and sit there, enjoy the breeze, see God's wonders, see how magnificent the ocean is. It's good for your mind in the right state. So let's look at the mistakes I was talking about. What are the mistakes people make, psychological mistakes people make as far as trading is concerned? We'll look at, I said there are 4. Getting out of trades too quick. You can take notes. If you don't have a pen and paper, don't worry. The webinar is being recorded. It will be posted afterwards, so you can watch it again and take notes. Getting out of trades too quickly. Too quickly. I'm going to list them down. Then we'll look at them individually. 2. Holding positions too long. I suffered from all of these things. 3. Skipping trades with fear of losing. With fear of losing. That was a 4th point. Or I think there's actually a 5th one. I'll add that one too. Getting into more trades than you should. I should actually make that 5 and make that one 4. Let me make that 5. Then make this one 4. 4 is what? Fear of missing out. Abbreviated as FOMO. Fear of missing out. So these are the reasons we are coming. These are some of the mistakes people make that we are coming to look at. And it will lead us into discussing a lot of more stuff because we are going to look at them extensively. So let's look at the first one. Getting out of trades too quickly. What does it mean? Of course, it's self-explanatory. Getting out of trades too quickly. You place a trade. Let's say you are buying USD CAD. Okay? Then it moves a few pips. You are buying it, so you're expecting it to go up, right? So you can make profit. But then you place a buy position. Then a few minutes after placing a buy position, you realize that USD CAD is not going up. It's rather coming down. Then you're like, why are you not going up? Why are you coming down? Then you feel like you are going to lose a lot of money because you feel like it is going to continue going down. Then you close it. You close it in a loss. Then just few minutes after you close it in a loss, USD CAD says, oh, okay, you close me. Now it's time to go up. Then it starts going up massively. And you feel really, really bad. You feel like an idiot, excuse me to say. It happened to me a lot of the time. I'll just close a trade. Then few minutes after closing the trade, I see it moving up. Then I feel like an idiot. So what causes that? What causes people to get out of trades too quickly? Now, it's a psychological problem as far as trading is concerned, but it has its roots deeply embedded in technical problems. If you are getting out of trades too quickly, it is because you are afraid that the trade will lead into a loss. Why are you afraid that the trade will lead into a loss? So that brings us to fear. What causes fear in trading? Why are you afraid that the trade will lead into a big loss? So you decide to close it. You get out too quickly. Then the trade starts to go up. Why? What is the cause of that fear to happen? So the reason why you are getting out of the trade too quickly is because you don't have enough information. You don't know if you don't know how to tell if the trade is a lost trade, or you don't know how to tell if the trade is still valid. Trust me, some of the trades, when you enter into them, they retrace a lot before they move out. Now, I, for one, if I'm in a trade and then my trading setup is not violated, I don't get out of it. I only get out when I feel like the trade is violated. How do I know it's violated? It's because I understand the market. I know order blocks, liquidity, and all of those things, the very things I have been teaching you. So once the trade is violated, I know that, oh, this is a lost trade. And if it's a lost trade, I don't stay in it, I get out. I don't stay in it again because I know that it's a lost trade. So I know that if I continue to stay in it, I'll continue to lose. So I close it and then I look for other opportunities. Do you get me? So if you're having this problem, some of you might be having that problem, getting out of trades too quickly. It is because you don't have really deep knowledge as to how the market works. So it's psychological, it's as a result of fear, but the fear is because you don't really understand the technicals. So you have to work at understanding the technicals really, really well. So when you enter the trade and it's retracing against you, you know what is happening. So you don't panic. You are not afraid. You don't panic and you don't shiver to close a trade. Do you get me? I'll show you examples of that on the live chat. Let me see if I can find an example here. This is CHFJPY. Yes, I think we can find an example here. You see, this is CHFJPY. Let's say you sold over here where we have a 115168. You sold over there. It's not a bad place to sell because over there was a break in market structure. And you practice good risk management, so you didn't over leverage your account. Okay, but look, after entering over there, CHFJPY went up. If this was your entry, it went up 92 pips. You would have panicked and you would have closed it. Do you get me? But if you have deep insight about the market, you would have realized that there is a fair value gap here. Okay, there's a fair value gap here that they are going up to fill, and there's an old high here that they are going up to clear. It's a form of liquidity. So you know that that is only the reason why they are going up. So I'm not getting out of this trade. Even after they have cleared the liquidity and they have traded into this bearish order block, I'll add another position over there. So when the trade starts to play out, it comes down to my entry. So I make profit up here and I make profit when it gets to my entry as well. But somebody that doesn't have this knowledge will panic and then close the trade. Then he closes it the following day, the thing sells massively. And he feels very, very bad. Do you get me? So you will not get out because you know what is going to happen. You have prior information, you have knowledge about the market. So you know that the market is only going up to fill the fair value gap, clear this old high, and then trade into this bearish order block before it drops. So you will not panic. Do you get me? That is what I'm talking about. I sold it here, and when it went up, I realized that it was going to clear this. So I sold it again, and this position is currently in profit. And the profit here has almost nullified the loss that I incurred down here. Because the loss that was done here is still there. I've not closed that position. I'm still holding it. Then I have the position up here that is in profit. Do you get me? But back then, I would have panicked and then closed it. Then the following day, it drops, and I feel like an idiot. So I had to improve on my knowledge as far as the market is concerned. So if you have that fear, getting out of trades too quickly, work on your technicals. Seek more knowledge. Understand. Spend a lot of time on the charts. Okay? Understand. Watch good to go. So if you have this problem, that is what you must do. Improve on your technical knowledge. Okay, I didn't finish writing this. Holding positions too long. That's the next thing we're going to look at. Now, holding positions too long. What does it mean? It means you enter a trade as in profit. You are happy. You are so excited that it's in profit. You overstay your welcome. Then before you realize the trade has come back to your entry and it even goes past your entry. And instead of a profit, you are now in a loss. That is what it means, holding positions too long. So what causes people to hold positions too long? This one is as a result of overconfidence. I always tell you guys, no matter how bullish the market is, it is not going to heaven. And no matter how bearish it is not going to hell. So you must always have predetermined profit targets. Do you get me? You must always have a profit target. So no matter how bullish it is, it's not going to be bullish forever. I used to have that problem. I'll place a trade, then I am in 30, 40, 50 pips in profit, and I continue holding it. Because I was telling myself, oh, you see, I had that. This is a false narrative that is in the market that is causing a lot of people to become what they are not supposed to be. There is a narrative out there that the best traders are swing traders. I believe some of you have heard that before, that the best traders are swing traders. People who are able to hold their trades for long and they make so much pips, so many pips from their trade setups. I believe you have heard of it before. It's a false narrative. The best traders are not swing traders. The best trader is a trader who knows where to enter and where to get out. The best trader is a trader who knows that this setup is violated, so let me get out now. The best trader is a trader who knows that, okay, I'm in 40, 30 pips profit. This thing can reverse at any point in time. I think I should get out here. That's the best trader. The best trader is a trader that pays himself. What does that mean? The best trader is a trader that closes most of his trades in profit. So don't try to be a swing trader because your friend is a swing trader. It's nice when you see people hold their trades for a very long time, then they make 200 pips, 300 pips, 400 pips. But you should be so versatile that you know when to swing trade, when to trade a daily cycle, and when to scalp. I know all these things. So depending on the market conditions, I know when to swing trade. I know when to trade a daily cycle. I know when to do what? Scalp. I've held positions that have made me 800 pips before on GBP, JPY, and GBP USD. That was swing trading. I've held positions that made me 30 pips, 20 pips, 40 pips because I was trading the daily cycle. Do you get me? So don't hold your positions too long. And the only way you can solve that problem is to identify the type of trader that you are. And I keep telling you that the type of trader that you are, to a very large extent, depends on your personality. If you are somebody that is very, very patient, very, very patient, and it takes you a long time to make decisions, you can be a very good swing trader. And nobody knows you better than yourself. Maybe the only person that knows you better than you is God. But nobody on this earth knows you better than you know yourself. Do you get me? So you know your personality. You know if you're a very patient person or not. So if you're a very patient person and it takes you a long time to make decisions, you can be a very good swing trader. Now, we also have people who are not very patient and make decisions really quick. If you're that type of person, scalping will do for you. And to some extent, trading the daily cycle will also do for you. Do you get me? Then it also boils down to your risk appetite. People who scalp don't have a high risk appetite. So they get in the market intermittently. They get their 10, 15 pips, they are out. They get in again, 10, 15 pips, they are out. At the end of the day, it's a lot of pips for them. So do not let somebody's trading style determine how you should trade also. Come to understand yourself, know your personality, and your personality will lead you into the type of trader you should be. I trade a daily cycle sometimes, but most of the time I swing trade. Do you get me? I swing trade. I'm versatile. I don't like scalping because scalping makes me feel nervous. So I don't like to scalp. I like to trade a daily cycle and I like to swing a lot. And it helps me a lot. That's the type of trader that I am. So that is my personality, and that is what works for me. So you also have to find out what works for you. So you don't stay in positions too long. when you are in it and it's time to get out. You get out, then you book your profit. When you book your profit, we say you have paid yourself. So always pay yourself. So your profits don't turn into losses. So that is it. That can be linked to overconfidence and people trying to copy other people. Be yourself. Don't try to copy other people and don't hold on to positions too long. Then the third point, skipping trades with fear of losing. I used to suffer from this one too. I used to struggle from it. Back then, I could do really, really good analysis. Then I do my projections. I say this pair is going to reverse around here and it is going here. I don't know how long it will take to get there, but that is exactly where it is going. Do you get me? Then when it's time, when the market gets to where I think is going to reverse and it's time to trade, then I become scared. Why am I scared? Because the market is moving towards that direction with very strong momentum. So if it's a seller I'm looking at, it's coming up with a very strong buy momentum. I say, hey, the way this thing is moving with Vim, I don't think it will reverse from here. Then I'm scared. I don't take the trade. Then it gets there, rejects off there. Then it does what? It reverses and gets to exactly where I said it was going to get to. Then I feel very bad. So it was fear. Fear of skipping trades with the fear of losing. So why was I having that fear? It's because I was afraid to fail. That was the cause of that fear. I was afraid to fail. I always ask myself, okay, so what if I enter the trade and it doesn't work? The question you should actually be asking yourself is, what if it works? Don't ask yourself, what if it doesn't work? Yes, there's risk involved. You have to look at the risk aspect. And so you make sure that you have the right analysis. You have rules that guide you, that guide you. You know that this is where I should be selling at. This is where I should be buying at. So if it doesn't come to your buy or sell zones, you don't enter the trade. But once it gets to your buy or sell zones, pull the trigger. You are an assassin. Sorry, you are a sniper. You are lying on top of that cliff or on top of that skyscraper, and your target is way down there. You are lying there patiently waiting for him to appear. So once the target appears, you have to pull the trigger. You don't waste time, because if you waste time, the target may move and you have failed your mission. So you patiently wait for the trade to come to your zone, regardless of maybe you are selling or you are buying. So you wait for it to come to your sell zone or your buy zone. And when it comes there, do not be afraid that you may lose a trade. Don't ask yourself, what if it doesn't work? Rather, ask yourself, what if it works out? Pull the trigger. Why? Because it is at your premium zone and it's ready for sales, and it's at your discount zone, it's ready for buys. So pull the trigger when the trade comes to those levels and don't be afraid. So that is the third fear, the third psychological mistake. Now, the fourth one is FOMO, fear of missing out. FOMO is the exact opposite of the third one we just looked at. Now, what does it mean? There's one guy in the group, I'm not mentioning his name, but if you are very active in the group, you know the guy I'm talking of. I think he has FOMO. When somebody places a trade there, a screenshot, and then he sees that the person's trade has moved so many pips, then he's asking, so should we buy? Why is he asking that question? He's asking that question because he feels like this thing is really moving. If I don't get it, I'm going to miss out on this opportunity. But the trade has already moved. If a trade moves, let's say you do your analysis or somebody gives you a signal, then you miss the initial move and the trade moves about 20 pips. If it moves 20 pips and above, leave that trade alone. Don't buy from there. Or if you are selling, don't sell from there. If it moves 20 pips and above, let it go. That is why you have to understand market structure. You know that it cannot continue going forever. At some point, it will do what? It will retrace. It will pull back and give you opportunities to enter. Do you get me? But because you have that fear of missing out, and because you don't really understand market structure, once it starts to move, you feel like if you don't participate in it, you are going to lose money. So you jump in, and immediately after jumping in, it starts to retrace. It's retracing to come back, for that outside return to create, if it's a bullish market, to create another swing low before it starts going up. Let me do the illustration over here. Okay, let's say this is a market. It's going up like this. You were supposed to buy it here. That's where you were supposed to buy it. But you missed out on it, probably because you were busy or you were doing something. You were supposed to buy it over there. Okay? But then you come and then you realize that the market is already moving. It's moving with very strong momentum. Then you are like, oh, so this opportunity is going. I have to participate in this market. So you come and buy here around this level, which is a very terrible thing to do as a trader. You come and buy here, okay? Then after buying there, the market does this. Trust me, they are waiting for people like that. People who come and buy here, then they move down. Now, if you buy at this level, if you buy at this level, the message you are sending to me is that you don't know how to trade. Because if you know how to trade, there's no way you'll be buying here. Anybody that knows how to trade will never come and buy at this level. Because you know that you are buying at an inflated price and you know that there can be a pullback and you'll be in trouble. So because you don't know how to trade, that is why you are buying here. And because you are buying as a result of the fact that you don't know how to trade, once it starts to reverse, okay, you don't know that it's only reversing as a form of a pullback for the bullishness to continue. So you panic and then you close it in a loss. Then after closing it in a loss, the market does this again. So you see how the market is punishing you. It does that again, then you can say, so it has gone up again. Then again, you come and buy here. Yes, because you don't know how to trade. So you are just buying because you feel the market is moving up. So after buying there, they were waiting for you to buy. So after buying there, that's what it comes down again. But what you don't know is that, let me show you something. Because you don't understand market structure, you don't know that this is a break in market structure like this. And so they are only coming down to this level. Let me get rid of this. You don't know that they're only coming down to retest this break in market structure and then continue going up. So you bought here, then they decided to come down, then you panic again. This is where you bought it at. You panic again, you close it in another loss. Then after you close it in a loss, the thing starts to go back up, it comes back to your entry. Then you feel very bad. You feel really, really bad. So then you, because you are feeling really, really bad, you get angry, then you just close the chat and go and do something else. You see, funny enough, the people that do this, they don't look at themselves. There are those who go around and say, hey, Forex, you're fucking. The market is fucking. The market is not fucking. You don't understand how it works. Because if you understand how the market works, there's no way you should be buying here. There is no way you should be buying here. Okay? You should buy here. Do you get me? If you miss that opportunity, you should wait for it to retrace and you buy here. If you miss this one, you should wait for this one. Why? Because this is a resistance level that has become support. Do you get me? So if you are buying over there, there's a great likelihood that the market will continue going up. I hope you understand what I'm saying. So it's not the market, it is you. So the only reason why you are having fear of missing out is because you don't really understand market structure. So many of the psychological problems can actually be linked to technical problems. Because if you understand market structure, there's no way you come and buy here. There's no way you come and buy, because when you buy the retraces, you're in trouble. But you can buy here. Why? Because it's a previous resistance level that is broken. If you buy here, you are buying a resistance. But if you come and buy here, you are buying at a former resistance level that is now support. And we buy at support and sell at resistance. Do you get me? So that is what I'm trying to explain to you. So one of the ways, how do you solve this problem, this fear of missing out? First of all, work on your technicals. If you understand the technical charts, if you understand market structure, you will never have this fear. Another reason why people have fear of missing out is because they are thinking too small. They are thinking from a scarcity mindset. There are over 250 assets on Hantech platform that you can trade. Currencies alone are over 80. We have indices. There are even some synthetic indexes over there that you can trade. The volatility indices, some of them are there. They were added recently. You can trade them. You can trade commodities. You can trade stocks. So there are a lot of opportunities. But because you have a scarcity mindset, you feel like if you miss out on this opportunity, that's all. There's no opportunity elsewhere. That is how you get yourself into trouble. Okay, it's like being in a toxic relationship. You are a guy, you are dating a young lady, you can clearly tell that she doesn't love you. Okay, she's maltreating you, she's making you feel very depressed. But it's hard for you to leave her because you are thinking that if you leave her, you may not get another girlfriend. Man, the ratio of men to women in the world is like 4:1. If you're in a toxic relationship and you get out of it, you will find another woman that suits you and that will make you happy. So the only reason why you are in that relationship is because you are thinking from a scarcity point of view. So you get out of that relationship and you find a better one. It's the same thing here. So the fact if you miss this opportunity, don't think that is it. There are a lot of setups, a lot of assets you can trade. So if you miss out on one, that is not the end of the world. Other opportunities are coming. So once you miss out on this, forget it. Start to look at other person, analyze them, and you will get a nice setup to enter. Do you get me? So that is another cause of fear of missing out. So don't be afraid to miss out. Once the setup is gone, let it go. They say that the world is warmed by those who let go. Let it go. Look at other assets, look at other currencies, commodities, or whatever. You will definitely find opportunities because the forex market is like opportunities in the forex market are like buses. When one bus leaves, another comes. You always find a setup. You will always find a setup. If you look at as many pairs as possible, you will always find a setup. You only start from setups if you are just focusing on one pair. That is the disadvantage of trading one pair. Some people trade just one pair. So when there's no setup, sometimes you can have a pair consolidating for as long as 1 month, 3 weeks, 4 weeks. So if that is the case, because it's not good to trade during consolidating markets, it means you have to stay out. You will not trade during that time and you will not make money. But if you're looking at a lot more pairs, you definitely get setups on other pairs that you can place and then you make money. Do you get me? Then the fifth point, getting into more trades than you should. This one is as a result of greed. I'll give you another analogy. Forex is practical. This one is as a result of greed. I tell people during my seminars and webinars that the type of person that you are will show up in Forex. If you are a coward, we will see it in the market. Okay. If you are a womanizer, we will see it here. If you're a womanizer, this is a problem you have, getting into more trades than you should. You will want to trade every pair. You know, womanizers want to have every woman. So because you're a womanizer, in the market, the women in the market are the trades, the assets, the currencies, the commodities, and what have you. So because you're a womanizer, you want to trade every single pair. Unless you want to trade every single pair. As soon as somebody drops a setup in the group, you get in there, you place it. You place a trade. Let's say somebody drops a setup on USD CHF. He says buy. Then you buy it. Then a few minutes later or few hours later, another person comes to post, sell, let's say GBP JPY. You sell it. Then another person comes to post, buy gold. You buy it. So at the end of the day, you realize that you have a lot of positions on your small account. Then you over leverage your account. Then if there's a small shakeup in the market, you end up losing your account. Do you get me? And that is because in real life, you are a womanizer. So because in real life, you are a womanizer, in Forex, you are womanizing as well. You are chasing every single pair you see, you want to trade. So you have to find a way to overcome that. You should not trade every single setup. See, you cannot catch every move in the market. There are several moves every day. Even within, do you know that in every buy setup, there's a sell, and in every sell setup, there's a buy? But I don't teach you these things because I don't want to encourage that mindset, that way of thinking, that way of trading. It's a very bad habit. That is why I have not taught you counter trend trading. I've not taught you to trade against the trend, but there's actually a way of doing it. I used to do it. Sometimes I even do it because I understand counter trend trading, but I don't want to encourage that in you because that means that you are going to be going against the trend, which is not a good practice. That is why I haven't taught you. But in every buy setup, there's a sell, and in every sell setup, there's a buy. Maybe one day, if I'm touched by an angel, I'll teach you counter trend trading. There's a way of doing it. And those of you who are inquisitive and curious and like to try things on your own, maybe you will find out how it works. It happens on the 1 hour time frame. Counter trend trading. I'm giving you a clue. It happens on the 1 hour time frame, and it's usually intraday. Maybe one day I'll teach you how to do counter trend trade. But like I said, it's not a very good practice. That's why I haven't taught you. So these are some of the mistakes that people make: getting out of trades too quickly, holding positions too long, skipping trades with fear of losing, fear of missing out, then getting into more trades than you should. These are some of the mistakes, psychological mistakes people make that leads into serious losses. Then they lose money quicker than they came into the market. Okay, so now that we have looked at the mistakes that people make that leads them to lose a lot in the market, we have to look at what successful traders do that makes them successful. Please, the name of the man again. Which man? Which man are you talking about? I talk about a psychologist. His name is Mark Douglas. Am I right? Yes, Mark Douglas. I have a few of his videos. I'll post them on the group. You can watch them. His name is Mark Douglas. He died some years back. He was a very great trading psychologist. He himself started out as a trader at an institution. And later he went solo, then he learned some psychology, and then he used to host a lot of seminars, and he made a lot of money from his seminars on trading psychology. So I'll give you his videos to watch. So what do successful traders do? Now we've looked at some of the mistakes people make psychologically that leads to losses in the market. Now what we have to look at is, what do successful traders do? Now this is one of the things they do. Before I tell you what one of the things they do, let me tell you the 5 outcomes in trading. There are 5 outcomes in forex trading. Not just forex trading, trading in general. Whether you're trading bonds, stocks, commodities, indices, currencies, whatever type of trading you're doing, even options trading, there are 5 outcomes. 1, big win. Okay, big win. That is when you place a trade and then you make big money. Like today, anybody that sold gold and held it that long would have made over 1,000 pips. So even if you went in with 0.0, even if you had a $100 account and you went in with 0.01, today gold could have doubled your account for you with just one move. Do you get me? So we have big wins. That's one outcome. Big losses. That's another outcome. Small wins, small losses, and then break even. Big win, big losses, small losses, small wins, and then break even. Now, out of all these outcomes, if you're able to get rid of the big losses outcome, then you become successful in trading. That is something that troubles a lot of traders. Today, he makes a lot of money. The following day, he loses everything he made. I had that problem. Today, I make $400. I'm very happy. Then tomorrow, I lose $500. Then I ask myself, so what kind of +1 - 1 am I doing? It's like you take, it's not +1 - 1, it's +1 - 2. You take 1 step forward and 2 steps back. So what causes it? This is what successful traders do that prevents them from having such a problem. So never make a bad day cost you more than you make on a win day. Let's say if the average you make on a big win day is $200. Okay, let's say when you're winning big, you win about $200, based on your account size. That is the biggest you win. Whenever you're winning big, you win around, let's say, $200 to $300. If you're making $200 on your big win days, when you're losing, never lose more than $200. So if you make $200 today and tomorrow you are going to lose, you shouldn't lose more than $200. In fact, you shouldn't even lose half of $200. You should lose less. Do you get me? If you lose more than you win, it affects your confidence. Let's say you make $200 today, then tomorrow you lose $300. The following day you make $200, then the next day you lose $400. It affects your confidence. Your confidence becomes affected, and confidence is everything. Everything, every aspect of life requires confidence. And in trading too, confidence is necessary. Big losses affect your confidence. And once your confidence is affected, you develop low self-esteem and you start to feel like you are not a really good trader. I've gone through all these things. I remember some time back, I made a very big loss on gold. I was trading a $2,000 account. Then I placed a trade on gold. I was selling it. By then I didn't know liquidity, all the things I've taught you. I didn't know those things. I was using supply and demand, and even the supply and demand, I didn't understand it to a very great extent, but I was using supply and demand to trade. So I thought gold was in a supply zone, so I decided to sell it. Apparently, I was very mistaken. It started to go up. It went up, went up, went up. Instead of me to close it, I didn't close it. I didn't want to close it in losses. Then it went up, went up, went up. Then at some point, I realized that if I hadn't closed it, I could lose all of my capital, and I closed it in $1,200 loss. Then the money was left with just $800. My confidence took a big hit, and I felt like I wasn't good enough. So you know what I did? How I knew that my confidence was affected? I started looking for signal providers. Then I went and bought signals. The signals were not working. So I was just going through some rough. It led to a very long losing streak. At the end of the day, I had to withdraw what was left in the account. Finally, it was left with about $400, and I withdrew it from 2,000. It was left about 400, and I withdrew it. Then I used it for whatever I was going to use it for. So the reason why I got myself in that state was because I made a big loss, and it affected my confidence so much. So you have to get rid of big losses. Don't make big losses. Before you enter into a trade, you must always have a stop loss. Most of the time, my stop loss is psychological. I don't place it on the chart, but I know that if the market goes beyond this level, I'm getting out of the trade. That is the maximum I'm going to risk on this trade. So I don't incur a big loss. So if it exceeds that level, I just get out of the trade, because I know that the trade is now violated. The setup is violated. So the likelihood of it coming back to my entry is very, very small. So I get out of the trade. Then I look for other opportunities. When you do that, you prevent big losses. You avoid, that's the right thing, as you say, you avoid big losses. Okay, so your losses are never as big as your wins, and so your confidence is not affected. If your losses are bigger than your wins, it leads to a draw in your, it affects your confidence, and then it can lead to a very long losing streak, and that is not what you want. You don't want to be in that state as a trader. So that is one thing successful traders never do. They never make their losses bigger than their wins. Secondly, what's the second thing they do? Okay, know your stop loss level before you enter a trade. That's what I just said. You can either place it on a chart, or you can have it psychologically. It's called psychological stop loss. It's not on the chart, it's in your mind, and you are monitoring. You know that if it exceeds this level, I'll get out of the trade. So that means that you are only willing to risk a certain amount. The industry standard is 3%. Never risk more than 3% of your account on a single trade. So if you are trading $1,000 account, okay, and then you are in a trade, then you have a drawdown of 30 pips. That's 3%. You should get out of the trade. 30 pips. So the maximum you are willing to lose on that $1,000 account on a single trade is 30 pips. So if it gets to 30 pips, you are exiting that trade. You are not willing to risk more than 30 pips. Do you get me? That is assuming you are trading with what do you call it? A mini lot of 0.1. So 0.1, if it moves 30 pips against you, that is $30. So you are only willing to risk $30 on a single trade. So it is far easier to make back $30 than it is to make back $200, $300, $400, $500. Do you get me? So always have a stop loss before you enter the trade. Either you place a stop loss on your chart, or you have it psychologically up there. Do you get me? And one thing you should never do is never widen your stop loss. Never widen your stop loss. One of the bad habits people practice is that he has put his stop loss at 30 pips, but then the trade starts moving towards the stop loss, so he increases it to 60 pips. It's coming towards the 60 pips, then he increases it yet again to, let's say, 80 pips. That's a bad thing to do. Have your stop loss there and leave it. Know that if it hits your stop loss, there's always another opportunity. Regardless of what happens, there's always another trade around the corner. So you should have that at the back of your mind, that if my stop loss is hit, I'll get another opportunity. Okay, that also boils down to the what do you call it? Scarcity mindset. Some people have a scarcity mindset. They feel like if I lose this trade, I may not get another trade to win. So once you have set your stop loss, leave it. If the market hits it, you get other opportunities, either on another pair or even that very pair later on. You may get an opportunity on that very pair later on. So never widen your stop loss. Leave it where it is. Okay.